Well, hello there. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
Welcome. Today, we're going to deconstruct a concept that is absolutely central to business taxation in Canada, capital cost allowance, or CCA as it's commonly known. Now, this is the system that allows businesses to deduct the cost of their long-term assets, but not all at once. Understanding how this works is more than just an academic requirement. It's a fundamental piece of the puzzle for anyone dealing with Canadian tax.
So, here's our roadmap. We'll start by making a very clear distinction between depreciation for tax versus for accounting. Then we'll get right into the mechanics of the calculation itself. After that, we'll look at the first-year rules, which have seen some major changes. We'll also cover what happens when you sell an asset, the concepts of recapture and terminal loss. Then we'll dive into some special cases that break the general rules, and we'll wrap up with perhaps the most important point, the strategic choice involved in claiming CCA. All right, let's begin with the most foundational concept. You need to understand that the way an accountant thinks about depreciating an asset for a company's financial statements is completely 100% different from how the tax system handles it. And let's be very clear, this isn't a choice, it's a mandatory distinction.
You see, on the accounting side, it's all about matching expenses to revenues. Management makes its best guess about how long an asset will be useful. Maybe a computer will last 5 years, and what it might be worth at the end. It's an estimate. But for tax, we throw all of that estimation out the window. The Income Tax Act has a rigid, prescribed system. Every asset is slotted into a specific class, and each class has a set rate of depreciation. There's no guesswork. This system is capital cost allowance.
So with that distinction made, let's get into the mechanics. How do we actually calculate this deduction year in and year out?
The term you absolutely have to know is undepreciated capital cost, or UCC. The best way to think about UCC is as a running total or a pool for each class of asset. When you buy an asset, you add its costs to the pool. Each year, you calculate your CCA deduction based on that pool's balance. Then, you subtract the CCA you claimed, which gives you the new, lower starting balance for the next year. It's a continuous declining balance.
And this whole system is organized by these classes. For example, a standard car or minivan goes into Class 10, which has a 30% rate. Most office furniture and equipment, that'll be Class 8 at 20%. Even intangible things like goodwill that you purchase when you buy a business have a home. That's Class 14.1 with a much lower 5% rate. The calculation is always the UCC balance for the class multiplied by that class's prescribed rate.
Now, this is where things get really dynamic. The rules for the very first year you acquire an asset haven't been consistent. In fact, the government has actively changed them over the years, using them as a tool to either slow down or speed up business investment.
If you look at this timeline, you can see a clear policy story unfolding. For many years, we had what was called the half-year rule, which actually reduced your CCA claim in the first year. But then in late 2018, everything changed with the introduction of the Accelerated Investment Incentive, which dramatically increased the first-year claim. It started at 150% enhancement and is now settled into a 100% enhancement.
Let's put some numbers to this to see the real-world impact. Take a $25,000 car. Under the old half-year rule, you could only calculate CCA on half of that cost, which gives you a deduction of just $3,750. Now look at the peak of the accelerated incentive. It lets you calculate CCA on 1.5 times the cost, for a huge deduction of $11,250. Today, under the current rule, you get to calculate CCA on the full cost, which results in a $7,500 deduction. That's still double what was allowed under the old regime. The difference is just massive.
And this wasn't some arbitrary adjustment. The Accelerated Investment Incentive was a direct strategic move. It was introduced right after the United States passed major tax reforms in 2017 that allowed businesses there to immediately write off many of their asset purchases. So, Canada implemented this incentive to keep our tax system competitive and prevent Canadian businesses from moving their investments south of the border. It was pure economic policy in action.
Okay, so we've covered buying assets, but eventually assets get sold. And when that happens, a whole different set of rules kicks in. This can lead to one of two very different outcomes, something called a recapture of income, or its opposite, a terminal loss. Before we can figure out if we have a recapture or a terminal loss, we have to answer a more basic question. When you sell an asset from a pool, you have to reduce the UCC balance of that pool. The question is, by how much exactly?
And here's the rule. It's absolutely critical. You reduce the UCC balance by the lesser of two amounts: what you originally paid for that specific asset, its capital cost, or the money you got for it when you sold it, its proceeds. This lesser of rule is the gatekeeper for the whole process. It prevents you from creating artificial losses on assets that have actually gone up in value. So what happens if you apply that lesser of rule and it drives your UCC balance below zero? Well, that's called recapture. Let's say your UCC for a class is $10,000. You sell the last asset in that class for $15,000. When you reduce the UCC, it becomes negative $5,000. The tax system doesn't allow a negative UCC balance, so you have to add that $5,000 back to your business income for the year. Essentially, the CRA is recapturing the excess CCA deductions you claimed in prior years. You claimed more depreciation than the asset actually experienced.
Now, the flip side of recapture is a terminal loss. This can only happen when two very specific conditions are met. First, you must have sold or disposed of every single asset in that particular class. And second, after you've done that, there must still be a positive UCC balance left over. So imagine that same $10,000 UCC balance, but this time you sell the last asset for only $3,000. You're left with a $7,000 positive balance and no assets. The system allows you to deduct that entire remaining $7,000 from your income in that year as a final or terminal loss.
So we have our general framework for CCA, recapture, and terminal loss. But as anyone who has studied tax knows, for every general rule, there are exceptions. Let's look at a few common asset classes that play by their own, very unique set of rules. A perfect example is Class 10.1. This is for passenger vehicles that cost more than a limit set by the government. For 2024, that limit is $37,000. If your business buys a $60,000 car, you can't add $60,000 to your UCC. You can only add the prescribed limit of $37,000. What's more, each of these luxury vehicles has to be in its own separate Class 10.1 pool. And to top it off, when you sell it, the rules for recapture and terminal loss just don't apply at all. Instead, you simply take a half year's worth of CCA in the year of sale, and that's it. Let's look at another one. Class 13, for leasehold improvements. This is when you rent a space and spend money renovating it. Here, the entire declining balance concept is thrown out. Instead, we use a straight line method. And the logic makes sense, right? The value of those improvements is tied to the length of your lease. So the annual CCA claim is based on a formula that amortizes the cost over the lease term, ensuring it's written off during the period it actually provides a benefit. We see a similar idea with Class 14. This class is for intangible assets that have a specific finite legal life. Think patents, copyrights, or a franchise agreement for a set number of years. Again, we use a straight line method, writing off the cost over that legal life. A 10-year franchise is written off over 10 years. But Class 14 has another unique twist. The first-year claim has to be prorated based on the number of days you owned it. So if you buy that franchise on December 1st, you only get to claim CCA for the 31 days you owned it in that first year. And what about intangibles that don't have a limited life, like goodwill? That falls into Class 14.1. It uses a slow, 5% declining balance rate, but its most interesting feature is how it treats terminal losses. The logic here is that as long as the business is still operating, it's presumed to have some goodwill. You can't prove it's worthless. Therefore, the rules say you cannot claim a terminal loss on this class unless and until the entire business has shut down permanently. We have worked our way through the rules, the formulas, and the special cases. And now we arrive at what is arguably the most critical strategic point about capital cost allowance. It's the part that turns it from a simple calculation into a powerful planning tool. You see, after you've gone through all the steps and correctly calculated the total CCA available for the year, that number is a maximum. It is a ceiling, not a floor. And here is the key takeaway. CCA is a discretionary deduction. This means a business can choose to claim any amount it wants, from $0 right up to the maximum it calculated. You are not forced to claim it. And this element of choice is what makes CCA so powerful. It becomes a tool for tax planning. Think about it. If a business is already in a loss position for the year, claiming a big CCA deduction would just make that loss bigger. A much smarter move might be to claim zero CCA. This preserves that UCC balance. It keeps the pool full, so you can use that deduction, that tax shield, in a future year when the company is profitable and actually needs to reduce its taxes. This transforms the entire conversation from how much CCA can I claim to how much CCA should I claim to best manage tax liability over the long run.